It's hard to believe, but we're already at the end of chapter 18. And after chapter 18, you'll notice that we have two things happening. You're going to have an assignment for some points, and this is coming up. It will be posted and it will be available to you once as you complete this module. The other thing to note is that there's an exam. On our current schedule, we have an exam coming up, and we'll have some more information on that. So this is a time when you should be taking stock, you should be going back, and you should be looking at the chapters since our last exam. In chapter 18, I love this outline because it's so straightforward, and sometimes we have outlines that just seem to ramble on and seem like they defeat the whole purpose of an outline. And the purpose of an outline is to make things simple. It's to categorize things and to put them in a logical order so that when you learn concepts that they flow, and you can relate what's being discussed to other things. And it's much easier, as I've said many times, than going back and reading your Spiceland textbook. You notice in part 1 it says the sources of shareholders' equity, and it says that, well, first you can actually receive money or get money in to fund yourself from two sources, and that would be equity and debt. Then when you go down and you look further at equity, you notice in B here it says that there's two types of equity, and the two types of equity they say is paid in capital, and you know how I hate that by now, right? It's called contributed capital because it's a gift. And the other one is retained earnings. And of course, we have also AOCI, and we have a lot of accounts that they are conveniently putting in what they're calling paid in capital, that are not just issuing shares of stock. It's a little more complicated than that. And one example we have in this chapter is common stock distributable. That's not common stock that's been issued, right? So that's a little bit of a simplification, but generally we say that shareholders' equity is created by mainly two things: contributions, which is contributed capital, or it's earned capital, which is retained earnings. As we travel down here, then we start talking about comprehensive income again. And those of you who know me know that I really do hate this concept of other comprehensive income, because it's not really net income, and they call it they say traditional net income. I don't consider it to be net income, because comprehensive income is a total of the OCI, other comprehensive income items, and traditional net income. The definition, though, is pretty nice to read here. It says comprehensive income is the total non-owner change in equity for a reporting period. So comprehensive income includes traditional net income, or what we call net income, the earnings of a company, but it also includes the OCI items. And OCI is just kind of a thing that's floating out there, right? You know, I don't like the theory, the fact that it doesn't make our theory of accounting very cohesive. How do you handle then this components of comprehensive income? And what they're talking really here about is the OCI, other comprehensive income amounts. What do you do? How do you show that? Because traditionally with an income statement, as you've learned, the bottom of an income statement is net income, which is the earnings of the company. So what do you do with the OCI, or how do you show comprehensive income? That's what's being discussed here in B. And they say you can just really continue with it, and as an additional section of the income statement. So you'll have net income, and then you'll kind of tack on to the bottom, which is A. And the example I gave you for Berkshire Hathaway, that's what they did. They tacked it on to the bottom. The other thing you can do is put it in as a separate statement of shareholders' equity. Now, I am not saying this is the same thing as the walk forwards. The walk forwards on equity, which are required, and we'll talk about that in a little bit, are required. You'd have to do that as well as B if your option was to do B. And then you can also put it in a separate statement and put it in a disclosure note. However, it has to be in such a way that a person who is reading the financials can actually understand what is happening. What's your earnings? What is your OCI? What's the difference? So each component needs to be reported net of tax or tax expense, or as you now know, tax benefit. And you should show a comprehensive income and how it's accumulated in the account of equity. Now this is C, which is what I really wanted you to understand when we talk about the statement of shareholders' equity. Previously in your other class, you talked about it as a statement of retained earnings, and you called it one of the 4 required financial statements. I'm going to say, well, that's kind of the story, but you know, in Intermediate 2, we expand the story, and the expanded story is that if you have changes in any of your equity accounts, you need to do a walk forward. And typically the way it's done is to think of it as an Excel spreadsheet, and one column would be for retained earnings changes, one common column would be for common stock changes, one common column would be for paid-in capital changes for a particular common stock or preferred or whatever. And then you just show all the changes and you put a caption, and your caption is in your first column, which is column A. And that's the format, and that's typically the way it's done. What if you don't have any changes in any of your accounts? You don't issue shares of stocks, or there's none other of these other multitude of equity type transactions we could have. Well, then what do? Well, retained earnings probably will have changed because you'll have net income. So then you are reduced to what you learned in 201. You're doing a retained earnings statement. You're including retained earnings and doing a walk forward of retained earnings. Oh, paid-in capital. How do you like what I did that? Oh, how I hate that caption, which is what I do. What they're really talking about when they talk about in B is contributed capital. And they're going to talk about the rights of people who own shares in this contributed capital accounts. And they're really talking about preferred and common. I want you to know, C, the dividends on cumulative preferred shares, if you do not have any declaration of dividends, and it says that are not declared in any given year. Remember, I said you don't really declare dividends on preferred; you just declare cash dividends. If it's cumulative and they are not paid, the next time dividends are paid, they are going to have to be paid before any can be paid to common shareholders. We had so many problems on this. Yes, you're going to expect to see a problem. When preferred shares are not participating, the shareholders are entitled to no more than the designated dividend preference. And this is just the definition of what participating is. I said you don't have to be concerned with it. As far as I'm concerned, we are only going to say non-participating, and I'm going to have you look at the percentage. What they're saying here is if a preferred shares are participating, they could actually get more than the percentage. And if they are participating, then that means the common will get less and they'll get even more than that percentage. That's all you need to know. Par value is so arbitrary, and it depends on where the company is incorporated. That's what they say. Varies by state. It means nothing except in our journal entries. And when we have it in our journal entries, it affects us. It affects us when we have common stock that is distributable on dividends. It affects us when we have the issuance of stock. There's various places where it does show up as an issue. When you issue shares, generally you issue shares for cash. There can be times when you're going to give out something else. And when you issue something and it's not in stock form, you're going to use the same sort of consideration you always do in transactions, is try to figure out which is more evident, the value of that thing that's involved in the transaction or the stock value. And then the rule is to use whichever seems more clearly evident. We had a problem on that. You might want to review that. If you have more than one equity that is combined, so you have multiple things going out at the same time, and you know one value of one of the equity and you don't know the other, you take the total, you subtract the one you know, and that's the kind of the what was an unknown value, right? If you have two, you're going to look at the fair values and you're going to apportion it that way. Any of the costs associated with issuing shares that are really necessary cost in issuing shares will reduce paid-in capital. It says share issue costs are not recorded separately. All we want you to know here is, well, the share issue cost could be recorded separately. We showed that because if you issued a separate check, say, to pay it, what I want you to know here is that it goes to paid-in capital, and it reduces paid-in capital. It's a debit to paid-in capital. It is not an expense and is not something that is amortized. That's what I want you to know. And I think that that second misstatement, which is showing up in your outline, is misleading, but those are the things I want you to know about that. Throughout these outlines, they're talking about IFRS, and I have never really considered IFRS to be that important, so I tend to not cover it. And if you were to look at the schedule, you'd see that I cover it at the very end of the class, in the last topic. And now I think, from what I'm reading at the new CPA exam format that's coming out, we were expecting it to be tentatively released in July, and it was going to be coming out in January. This is in January of 2021 to be tested then. They were saying that they're thinking of not including any IFRS questions, which is just wonderful. So for now, I'm not really emphasizing IFRS at all, not even teaching it. I'm trying to exclude it. Now, if the CPA exam comes back and they later say, we need you to know these things, then I will incorporate and I will adjust accordingly. Reacquired shares. Oh boy, this is really an interesting topic because share repurchases, it really depends on whether you are retiring the shares in 3 or purchasing treasury shares. Most of the stuff we've been doing here, we have been handling as if they are purchasing treasury shares. They're putting them in a box, the treasury, and then we're going to send them back out again. And so that's the way we've been talking about it. You need to know, just in general, as I said before, that when you retire shares, you're basically canceling out that original issuing journal entry. So if you issued shares and you had a particular par and you had an amount above market for those shares and you had those values, and you have them showing up now as credits in your, say, common stock and paid-in capital accounts, you need to remove that amount, that original amount you put in there, if you are going to retire those shares that you have issued. And to retire them, you're going to have to go out there and you're going to have to buy them off of the market So you're going to go out to the market and you're going to pay cash. So you can think of it in the terms of a journal entry, it's the reverse of what you did. But the fact is, when you issued the shares, the market price would have been at some value, and when you retire them, the market price is going to be at a different value. You know, all of us hope that the value would have gone up in between the time periods if you're a corporation, right? So the likelihood that you're going to buy them back at the same thing that you issued them at is unlikely. So you're going to have another equity account that needs to be recorded. So some of you are going to say gains or losses, and I'm going to say no gains and losses, right? No gains and losses on our own share transactions. So it's going to be an equity amount. I don't want you to know that journal entry. I don't require you know that journal entry. All I want you to know is that once it's retired, it's reverse of issue, right? It's reverse of issue. And yeah, there's going to have to be an equity adjustment somehow, probably, because it can be gain or loss, right? That's the basics of what I want you to know. So in 2, they say decrease precisely the same amounts that were previously increased. And here I say just know that it goes to equity. Just know that it goes to equity when you're doing this thing. And corporations often then on C is a separate topic, and this separate topic is a thing we spent a lot of time on, which was treasury stock. And it is considered temporary theoretically, and that's why you put it in this debit account. And you view it as a temporary reduction in shareholders' equity, so you don't go back up there and you don't change your common shares in your dollar value in common stock or paid-in capital when you buy it back and you're putting it in the treasury. When you do this thing, you put it in a separate account called treasury, and it gets handled very similarly to inventory, and we talked about that if you have batches of it, how you'd handle it. And the point with treasury that I keep making is that when you have treasury stock, it has either a debit balance or it has no balance at all. You never have treasury stock with a credit balance. And the rules, what we do here is you don't record gains and losses. Instead, you take it to paid-in capital share repurchase, or call it paid-in capital treasury stock, that account. And in any of your paid-in capital accounts, the rule, again, on the debits and credits for them is they have to all be credits. So if you take a paid-in capital share repurchase as a debit, if you do that too much, you'll end up with a debit balance. You can't do that, so you just take it to retained earnings. The characteristics of retained earnings. This is, again, earned capital. When you do dividends, you need to take the dividends, whether they're stock, whether they're cash, whether they're property. It's the fair value of whatever you're distributing. Take it out of retained earnings. One of the things, though, you need to notice is that there are a few exceptions. That would be if you do stock dividends and they're large, and that's because you're taking too much out of retained earnings. So in here we're talking about a small stock dividend. Yes, you use the fair value, but if it's a larger than 25%, you're going to use par. The other option is the option which is B, a stock distribution of 25% or more. Now it says is a stock split. I'm going to say it can be shown as a stock split. So if you're going to do a stock split or you're going to do a stock dividend, you're going to use the phrase effected in the form of, and that's going to be what the journal entry looks like. Whatever it says, effected in the form of. If it's a stock dividend, it says effected in the form of a stock dividend, as this one does in 2, then it's going to come out of retained earnings. And if it's a big stock dividend over 25%, you're going to use par, right? And on the other hand, if they said it's a stock split and they don't say it's done as a dividend, then you're not going to do a journal entry. So you might review all of that stuff there, all that stuff. The final point in all of this that is really what I think is quite interesting is earnings, price earnings, and the PE ratio, which some of you are familiar with. I like to use PE ratios when I'm looking at stock to buy. And there's another thing that you look at, and it's a PE ratio that relates to growth, and I think this is interesting because the price earnings ratio can also be related to the time of the company and its development, its developmental cycle. So if you're a financial major, you kind of appreciate what I'm saying here then is that the shareholders' equity and the price earnings ratio are related. So when we say price earnings ratio, we are saying price per share divided by earnings per share. So that's the price earnings ratio. Now price per share, you kind of got introduced to that a bit in this chapter because we're talking about doing stock splits, we're talking about doing stock dividends, and the effects that those things will have on price per share. In another chapter, we're going to be talking about earnings per share and how earnings per share is calculated. And earnings per share is not just net income over ending shares outstanding. It's a little more complicated than that. But when you look at price earnings and that ratio that's so important in finance, it relates back to what we do in accounting. I think of the two disciplines within business that are the most related, I really do believe that it's finance and accounting. And I know some of you are double majors, and I'm sure you should be anyway seeing the relationship as you take your classes.